Hello and welcome back to the Note. Well, trading is over for another busy week, and I suppose the highlight continues to be China. Shanghai Composite was down exactly 10% for the week, plainly not out of the woods yet. Beyond that, you saw a continuing growth scare across the emerging world, a continued fall for emerging market foreign exchange. That continues a pattern that's been going on for some years. You also saw continued drops in commodity prices. But you can't say that that's too severe because overall world stock markets did actually have a positive week. They were up somewhat. Now, next week, it's the first week of the month, always very busy for data and could critically set the direction for where markets will be heading once people get back from their vacations. To start off with, on Monday, the first day of the month, you get PMIs, Purchasing Manager Indexes from around the world. These are wonderful leading indicators of economic growth, and they're very useful for comparisons because they're all fixed so that a measure above 50 indicates growth and below 50 indicates recession. As you can see, China for a while led the world out of the Great Recession, has been becalmed almost exactly on that 50 line for a long time. Various other blocks in the developed world appeared to be showing leadership at one point or another. All have been declining recently. It will be fascinating to see where that picture changes next week. After that, there'll be plenty more data, but the biggest set piece events when it comes to monetary policy will be the meetings of the Bank of England and the Bank of Japan. Now, as you can see from the way the pound and the yen have behaved, these two central banks are in many ways polar opposites. The Bank of England, according to some, could even be the one big central bank to start raising rates ahead of the Federal Reserve. I think that's unlikely, but there are employer organisations lobbying for that, and as you can see, sterling has defended its value against the dollar in an era when the dollar has been extremely strong, remarkably well. Meanwhile, the yen obviously has very deliberately collapsed against the dollar. That is a deliberate policy in line with the aims of the Bank of Japan. It will be very interesting to see how that continues after their meeting this week. However, the critical information that we're going to get next week comes on Friday with non-farm payrolls. That's because the thing that matters most to markets at the moment is when the Fed will raise rates, and we learned from the Fed this week that that will depend critically on unemployment data. Now, we did get a very important data point on employment at the end of this week. It's the Employment Cost Index, which shows you how much employers are spending on employing people. And as you can see, it is not showing any great inflationary strength. In fact, if you look at it on a quarter-on-quarter basis, this was the lowest increase since the early 1980s. There's little basis here for the Fed to feel obliged to raise rates. However, this is only one part of the picture. On Friday, it's going to be necessary not only to look at the headline change in non-farm payrolls, but particularly at what happens to average earnings. Any clear pickup, and this will be a classic case of where the interests of Wall Street and Main Street diverge. Rising wages is, of course, exactly what the economy needs. It's exactly what many Americans need. It's not what Wall Street needs. It would lead probably to higher rates sooner rather than later, and would be a problem for securities prices. We will learn next week.